Hello my friends, this is Torsten, first video of the year, or this time you can call me Mr. Wang, because I bought two Chinese stocks, the first stocks I bought this year, and in this video I will tell you why I bought the stocks and of course which stocks I bought. Investing in China, what does that mean? Or first a disclaimer, if you don't want to lose money, then just don't do anything someone on YouTube tells you to do. I'm not going to tell you to do anything, but don't get misleaded. Don't do anything I do without thinking about it better twice. Okay, I will tell you which stocks I bought and why I did. First, maybe why Chinese stocks, because China is the future. China is at least a part of the future. I will show you what I mean with this. Look at the annual growth rate of the gross development product, or what is gross domestic product. Yes, that's my English. And here you see that this is the corona pandemic negative, and then we are back on recovery, and economy in China is growing again once more, while in the United States and most parts of the Western world the gross domestic product is still shrinking. That's just one quick view about the facts. Okay, I don't say that the Chinese numbers are correct for each single digit, but it should give you just the raw picture. We have in China some of the biggest and most successful companies of the world. If I say Alibaba to you, you will say, hey, I know that Jack Ma is missing and that the IPO of the Ant Group was cancelled just 1 or 2 days before. Okay, we come to that. And I analyzed Alibaba more than once, but still, we have a growing economy and we have nice chances, opportunities there, but we also have risks. I already touched it on the surface. We will also handle this. But I think if you want to diversify your portfolio and accept some challenges, then China might be one direction to aim. Although we have these political conflicts right now between the United States and China, we have these tariffs and the economic challenges, disputes, and now we have the delisting discussion. There already happened some delistings of Chinese telecommunication stocks. So these are threats. We have political uncertainty due to Chinese regulations within China itself. I come back to Alibaba, for example, the abuse of its market power, condemned by the regulation, the Chinese regulation, but we also have different things in the Western world. Amazon, Facebook, Alphabet, they all know what I mean. But on the other hand, as I already said, there is a big power, big economic power with many opportunities, and they handle, for example, the corona pandemic very well. And thanks to this, they are back to the economic growth, and we are in the Western world, at least partly, still lag behind. So how to handle the risk of investing in China, these specific risks? First, if it's possible, my advice, don't buy ADR, but go with the original stocks. Some stocks like Alibaba have listings in Hong Kong, Shenzhen, or Shanghai. These are the three exchanges in China. Go with these if you can. Mostly you can. Buy not companies with recent IPOs, but by companies with a history, with a track record. They are more secure. For example, then you don't buy Luckin Coffee, the next Luckin Coffee, for example. Buy companies with a large market power, or in the large market capitalization, especially. Companies which are mostly domestic, because many Chinese people will invest into these companies, because if there's some kind of fraud happening, and fraud happened to people from abroad, not from Chinese people, then it's no legal problem for the people within China. And our advice, don't fuck with the Chinese government. I mean, invest in companies which don't have no conflicts with the Chinese government, like it's the case for Alibaba, because this might have a bad ending. Invest in companies where the Chinese government, Chinese is somehow affiliated with. And for example, the Chinese telecommunication stocks, they were delisted because of links to the Chinese military and Chinese government. Okay, I will come to the stocks I was buying, and so we load the dividend screener. By the way, it's my dividend screener, and I create a watch list, and on this watch list I have these two stocks. It is ad hoc, 3 stocks even, and we need to change the ranking because it's dividend stocks, dividend income stocks mostly, and we have the ranking here. And you see 3 telecommunication stocks, exactly the 3 stocks which were delisted recently, and 2 of these stocks I bought. We have China Mobile. This is the behemoth. It's the big telecommunication company in China. Look at the market capitalization, 110 billion US dollar. And then we have the 2 challengers here. And which stocks did I buy? I bought China Mobile and China Telecom. Let's have a look at the fundamentals, regardless of which stock you buy as an investor and which nationality the stock is or the company is. You always have to do the same proper fundamental analysis. So let's do it with China Mobile. And here you see the margins, operating margins. We also have other margins, but just go with this one. And the revenues on company level. And you see that we have 2 time frames, periods. We have the period of fast growth till 2013. And then we have the period of stagnation, the period of fast growth, not only of high revenues, but also with strong margins. And then we have this phase of not only stagnating but decreasing margins and sluggish revenue growth, if any growth at all. This translates to earnings per share metrics which mirror this evolution. So phase of stagnation here regarding earnings per share, even decrease in free cash flow per share, and stagnating dividends, while the dividends increased nicely from 2.3 to up to 2.8 and then still to 2.13. And I still bought this stock. But maybe before saying why I did so, I need to explain what happened here in the phase of stagnation. So obviously we have high margin pressure here due to regulatory, how do you say in English, regulatory demand from the Chinese government. They are interested in digitalization, in expanding the mobile communication within China to boost the technological advance in China and to make the internet, not the free internet, but the technology available to anyone. You know that in China, smartphone is even more important than in the Western world, and that's no joke, because for example in China they don't pay with credit cards, they pay with their digital wallets, and they are used on the mobile phone. So this is a very important thing, and due to regulatory measures of the Chinese government, the margins came under pressure, but the worst is already behind. That's the speech of CEOs of telecommunication companies, according to my knowledge, and you can also see it here. This was a really dramatic slump of margins, and now very slight decrease. So the worst seems to be behind regarding margin pressure. We also have here these decreasing free cash flows here. I already mentioned that. That's also due to the 5G, not all years, but some of them here, the most recent ones, also pressured or boosted or demand of the Chinese government. And on the other hand, on the one hand, high investments, lower cash flows, free cash flows especially. On the other hand, higher average revenue per user for the future, because these tariffs are more expensive than other tariffs for the customer. So I think that the worst is behind for these stocks. There's also another thing. It's a delisting thing. I don't have the TradingView or another chart tool open right now, but you might already guess that what delisting means. It means setting pressure, especially from American investors, institutional investors, partly also private investors, especially if they only are the ADR of the stock. And of course, I invested in the original stocks. You can see the ISIN here. It's not an US ISIN, for example, but it's Chinese ISINs from China here, and here it's Hong Kong ISINs. I just remind you, we have different exchanges in China, and this one is from the China exchange, from the Hong Kong exchange, and this one could be Shenzhen. Okay, anyway, why did I invest in these stocks? Because normally I am an advocate of investing in stocks with growing earnings, growing cash flows, and growing dividends, and then buy these stocks and keep these stocks as long as you can, if the story is still intact. And here obviously we have some problems. It got worse regarding the fundamentals than it was before. And I still bought this stock because of its valuation. And this time, this is an exception. I don't want to keep these stocks forever. And it's not a buy and hold investment, but it's a medium-term investing. I want to keep the stock for 1, 2, maybe 3 years, and then sell it after the stock price reached its fair value. Fair value, what do I mean with that? I mean that the stock is, in my point of view, undervalued right now. Let's look at the dividend turbo to give you an example. Right now we have a dividend yield of close to 8%. Here we had some special dividends, and this gives you the monthly dividend yield of the stock. If you just look at that, let's keep that. And you see here these close to 8%, and that's much more than we had in the past. In the past, there was a dividend yield between 2 and 4, up to 5%, but not more. And now we have these 8%, and dividends are still an estimate that they are slightly growing in the future. I should maybe explain you if I think that dividends are safe or not. Yeah, I think it's a good idea. So let's add the dividends and the free cash flow. If you just see this, then we see that the dividends are exactly covered right now based on the last 4 quarters. And then the free cash flow is expected to grow. And then there should be more room for safety right now, because the free cash flow exceeds the dividends, while here they are hardly covered or not covered at all in 2018. And here you see that in 2018, although dividends were not covered, they were not cut. So this already tells you something about the management's dividend policy. They're not going to cut the dividend because they are not covered by the free cash flow. By the earnings, they are always nicely covered. What's also very important maybe is here what's about debt level and what's about the treasury, about the cash of the company. Can they, for example, resume dividends if they have some bad years regarding free cash flow? And I can tell you, yes, they can. First, we have the debt ratio. It's a complete debt amount divided by the amount of the complete assets, and it's 35%, even a little bit less. And I think for a telecom stock, that's not much. I think AT&T, Verizon, and other stocks have much higher debt ratio than China Mobile. What's also very important, let's get rid of debts, and anything should always be so easy to get rid of debts. And here you see that they have cash of 521 billion Hong Kong dollar, and they have dividends spent for the complete amount on company level for dividends 60 billion Hong Kong dollar. So they now have cash or cash similar to cash in their balance sheet to pay dividends for about 8 years just out of that. And combine this with free cash flows which already cover the dividends and low debt level, here the debt ratio, then my conclusion at least is that dividends so far are safe. By the way, we don't have share repurchases here. So it's a Chinese stock, not a US stock. If it were a US stock, then we would have here high repurchases of stock because they have so much money within their balance sheet to wait to be spent somehow. Okay, so I think dividends are safe. Huh? That's my conclusion at least. 8% dividends are safe, 7.8% dividends are safe, but I am not dividend investor. Normally I'm not investing, or I did not buy China Mobile because of high dividends. I bought them because of their supposed undervaluation. And look at this, and here you see the dynamic valuation, and here we don't have for 24 all estimates, so that looks better, and we still have 3 years to go in the future, and for me that's enough. Again, we see the stock price here, and you see that the stock price, it was not a happy investment within the last 15 years. If you look at that, you even had capital losses if you invested 10 years ago. That's not very nice. So we have a stock here. You need to buy the stock in the right time and sell it in the right time, in my point of view, and I hope I found the right time. You never find the bottom exactly, and I bought the stock on Thursday, and on Friday it went down again 3-4%, but there I don't care yet about that. You never find the bottom. Okay, I already explained the earnings growth, and then why this sluggish second period, where it's coming from. Now it's still important for valuation purposes, because we have to find the right time frame to calculate the multiples here, and I limit the time frame, or I start the time frame to calculate these multiples starting here when things already deteriorated. And then we have the multiples calculated with using these years here, okay? And then we have these price earning and average price earning based on reported earnings 11.4, price earning based on adjusted price earnings, this ratio it's 12, price to operating cash flow 5, and the historic average dividend yield was 4.6%. Now it's, as already told you, about 8%. So from a dividend perspective, the stock obviously looks undervalued. Here we have this special dividend bar here on the top. Let's get rid of all these and let's concentrate on the valuation now. Our current stock price is 41.50 Hong Kong dollar, by the way. And let's show what that means if we apply all these historic averages, multiples, and then let's zoom in, start 2040, for example. So here we are, and this is the fair value of the based on the dividends. Let's get might be a little bit confusing, but the company got more valuable because of this special dividends. You see it here. Don't be confused. And here we see that the stock was overvalued here based on these historic average multiples, and then now it looks undervalued here. I even zoom in a little bit more, then we have an even nicer scaling if we zoom just here. Even a little bit more, one more year, and this is just what we are interested in, because this is the present and this is where we need to decide. I already decided, but you might decide if the stock is interesting for you or not. So we have, using these multiples, we have fair values between 70 and about 80 Hong Kong dollar, and the stock is worth half as much right now. So this is obviously an undervaluation, a proposed undervaluation, buy it or not, but in this kind of view it is, in this point of view it is. And now what to do with that? First, we have price earnings of below 7 right now compared to these historic price earnings, and you might be skeptic if the stock China Mobile will reach these averages again because of the sluggish growth. And then I will say, yes, maybe you are right. And when we should to adjust the valuation to be more careful. So if you want to calculate the expected yield, if you buy the stock right now, then maybe it's not a good idea to base your expectations on the fair values, which are calculated like this with these multiples, which would suggest an annual yield of 30%. That's Amazon-like with a telecommunication stock for the next 3 years, or for the 3 years. It's exactly 3 years, but you should lower your expectations. You might this by lowering the multiples we applied. For example, instead of 90, instead of 11, you enter 9. Okay, this is an auto suggestion from my browser, and I made this just for here. You see, and we could also lower it here, 9 for example, and then this is lower too. We could do this with anything, but I think it's too cumbersome, and I get rid of this. So, and now we are back where we were. You can also lower your expectations if you just start calculating from a lower point. And this is just what I'm doing. So basically, I go back and I search a valuation which seems to be more careful by going down here on the level. So we have this range from 90 to 76 Hong Kong dollar, and I lower the fair value, lower, up to 57 Hong Kong dollar. So it's instead of going here, I'm going there, and then I connect it with the current price of the stock, and then I still have an annual yield, expected yield, based on capital gains, you see it here, and dividends of close to 18% year by year. The total yield would be 63%. And in my point of view, this is an attractive opportunity. China Mobile is also affiliated with the China's government, which is exactly the reason for the delisting. And we have this selling pressure here on the stock, also not only due to economic reasons, this what I explained here with the margin pressure and all these things, but we also have selling pressure due to political reasons, due to this delisting. And this is, I think, now a nice opportunity to buy the stock, not the ADR, but the original stock, as I already mentioned. And then we have this risk minimization, because one thing is you don't have the problem with the ADR delisting if you invest in the original stock. And second is we have no hard problems to expect. There's no clash between the company and the Chinese government to expect, because the company is already controlled by the Chinese government. You see it here, this affects it workstation, and you will see this, the 72% and 70 close percent. The company is owned by the government or government affiliate entities, so this clash won't happen. If the government says something, they will just do it, as they already did by lowering tariffs or investing in 5G. So, and I think if I put all this together and I see this annual yield, expected annual yield of close to 18% by already lowering the fair values, then I think the stock might be an attractive buy for a diversified portfolio. And I hope, my expectation is that the stock price will recover up to a level I was drawing here. And if that's the case, somewhere I will sell the stock. And meanwhile, I will get my dividends. I think that the dividends are secure, and I have time to keep the stock as long as I need until it recovered on a level high enough for me to sell it again. For China Telecom, I did something very similar. I preferred it to China Unicom due to fundamental metrics, and I just wanted to diversify my investment by the company which is the number one in China's telecommunication sector, it's China Mobile, and by one of the two challengers. Okay, would be interesting how you think these stocks, if these stocks are interesting for you, and if you think that Chinese stocks are interesting right now, because there's a hard discussion going on for and against investments in China. Just drop a comment below. Then thanks for watching. Good luck. Have a nice and successful year. Keep safe. Keep healthy, and see you next time. Bye bye.